Our mission at Resilient Advisor is to have a significant impact on the retirement crisis by educating and empowering financial advisors to better serve their clients. We bring you industry thought leaders and experts to help you make a difference in the lives of your clients.
Thanks for tuning in to this episode of The Resilient Advisor. My name is Jay Coulter, and joining me is Lenore Hawkins, my regular guest to talk all things economy. Lenore, where are you joining us from today?
So just landed back in San Diego last night, which was, because now with post, thank God, okay, I'm not complaining because first off, post this pandemic nightmare, there are actually flights again. So that's kind of exciting. But trying to make connections is a completely different thing because particularly for international, you still don't have the volume. So I had the joy of sitting in Heathrow for 5 hours, London Heathrow. No one should have to do that. No one.
5
but
hours
made
in
it to
Heathrow?
San Diego. Yeah, 5 hours in Heathrow.
Is Heathrow, we're recording this in November of 21. Yeah. Is it crowded at Heathrow now?
It was bizarrely crowded. Yeah, it was actually, I was happy to see it because back in, was it July of 2020, I was on one of the first flights coming through from Italy to the States and flew through Heathrow. And it was, I think you and I talked about it, it was stunning. It was terrifying. It was like the Armageddon had hit. It was where you've got normally like 12 huge panels filled with flights for the day. There was all of one panel that was like 3/4 full. There was that few flights and they'd closed a ton of the terminals. This time through, it wasn't like crazy busy, but it was kind of like a low weekday. So
there's some
yay, the world coming back.
People are moving around. I love it.
Thank God. Yeah, it was really nice to see. And people were just normal. I mean, everybody's wearing masks, but that's the new normal, right?
All right. So Lenore's been a regular on The Resilient Advisor for almost 2 years now. This will be her first episode on the newly launched Financial Advisor Television. To learn more about the official launch at the beginning of next year, please visit financialadvisor.tv. That's financialadvisor.tv. Lenore, I love the way you prep for these shows. Let's get started. What are your thoughts around real GDP?
Yeah. So last week, we got our first estimate for the third quarter GDP. And it came in at all of 2%. That was pretty significantly below what consensus was estimating at around 2.6. But keep in mind that estimate, that expectations for 2.6, that was way down from just a couple months earlier when the majority were expecting we were going to see 6% in the third quarter. And now we're down to actually 2%. But what I found really, really interesting out of it is, because you and I talk about, all right, well, is this good? Is this bad? Both the bulls and the bears could find something to get really excited about and kind of finger wag at the other side. For the bears, real final sales contracted fractionally about 0.1%. And if we strip out both the state and local government expenditures and inventory accumulation and this kind of guesstimate that they come up with, it's this whole intellectual property spending, the real GDP would have actually contracted at 1.2% annual rate. So the bears can look at that and go, see, I told you the economy is all going to hell. This is terrible. But for the bulls, real GDP, if we had taken out the mess that we've seen in the auto sector, right, with all those chip problems, and so the car makers can't actually make the cars and there's just this glut. If we could take out that whole impact from what's going on in the auto sector, real GDP would have come in at a 4.7% annual rate. Now that's fantastic. That's better than we've had in decades, obviously excluding the spikes that we got post-pandemic. But that's a really great number. So both sides can be quite pleased, which I think just means going into the fourth quarter, we're not really there yet. And there's still so much distortion going on in the economy that it's really hard to say for sure what's going on. The consumer spending, right? Because we've talked about that. Is a consumer happy? That's really slowed in volume terms to about 1.6% annual rate in Q3. That's really low, 1.6%. That's down from 11.4% in Q1 and 12% in Q2. So that's a huge drop, but consensus was expecting only 0.9%. So it's kind of still a beat, even if it was a sharp slowdown.
Yeah. So there's some implications for all that I know we're going to unpack. We want to talk in your notes. You want to talk about inflation and rising yields. If you don't mind, I'd like to play you a clip from another regular guest we have, Michael Gayed, and he recently shared some thoughts that I want to get your opinion on.
I can make a case to you that given the way inflation expectations have been behaving, that yields should be a hell of a lot higher unless inflation expectations are wrong, which is just sort of a side note. We have this kind of interesting tug of war between absolute yields and inflation break-evens within the bond market itself.
Given that construct, A, what are your thoughts? And B, how should financial advisors think that through as they're managing portfolios here at the end of the year?
Yeah, I think he's dead on. So we've got all of this inflation data that looks on face value, it doesn't look so good, right? We keep seeing inflation going up, prices going up. But if you look at the bond market, and the bond market has a long track record of being pretty good on this stuff. You know, the bond market is a smart one. The equity market is the one that's kind of gets a little overexcited and then overly depressed. And the bond market's a little bit more stable. The bond market, we're not seeing these things reflected. In fact, if we look at, here we go. Yeah. Look at this 10-year yield. I mean, how is it that we're supposed to be having this really dangerous high inflation when the 10-year yield peaked, the most recent peak, it peaked in November of 2018 at more than 3.2%. And today it's under 1.6. So it's less than half of that. So 3 years ago, it was twice the rate it is today. And 3 years ago, no one was talking about this terrifying inflation. And it isn't really just the treasuries that are remaining low. If we look at both the investment grade and the high yield rates, those are also staying really, really low compared to what we've seen in the past, back when we weren't talking about a crazy inflation. So the bond market, it's not really buying this whole inflation story.
Well, what is Lenore Hawkins buying?
Well, I am still in the transitory, but that transitory camp, I think even the word transitory is a little bit misleading. The transitory sounds like it's just, well, it's a temporary thing that's going to come, but you have to look at what's really driving this increase in prices. And it's really all about, we've slammed the economy shut. I mean, we stopped everything all over the world. A bunch of things got stopped. And even more important is that we really messed up the supply chains, meaning we messed up moving things around. So you think about what it takes to put a car together, like the hundreds of thousands of parts that go together. And if you're missing just one of those parts, you really can't put the car together, right? And you think about how much of our economy is based on that. It's buying things that have a lot of pieces, and those pieces all come from all over the world. So not only do you have the manufacturing and all those little pieces that need to get together, but you have the transportation. And as we've all seen, transportation could not be more of a disaster, right? We've never, ever seen this many ships sitting off the West Coast ports, and they just can't get in. And we've got this mess where the ports can't get enough in. Then even if they get the big metal containers, right, even if they get those things in and empty them, they don't have any place to put the empties. And then you've got a problem. So here we've got all these full ones in the US that we need to empty. Then over in China, they're missing a bunch of empty ones, right? Because this used to be this really finely tuned machine. And what we did is just threw a mess into it all. So it's still going to take time. And that goes back to why I still think it is transitory, because when people keep talking about like, oh, well, we're heading for the 70s inflation. And part of that problem is, what do we mean by inflation? So inflation, if we think about inflation, is really sustained increased prices basically across the board. Like, it isn't inflation if orange prices go through the roof because we find out that oranges cure cancer, right? And the price of orange is up 10 times. That's not inflation. That's an increase in demand. Inflation is if everything across the board basically goes up significantly and it stays up. Well, it's not a surprise that right now prices are up because it's kind of a mess to get stuff, right? The shipping's a mess. The manufacturing processes are a mess. So prices are elevated. But are we really facing like this increase in demand? Well, let's see. We had a bunch of people lose their jobs. We had a bunch of companies have to take on a ton of debt just to stay afloat. And at the end of all that, we had a bunch of people die. We had a massive amount of damage done to just manufacturing plants. And at the end of that, the economy is going to be better off. And then on top of that, you have people saying, don't think I want to work the way I used to work. And that's really changing the relationship between companies and employees. And is that really going to create this elevated demand? When you think about what happened in the 70s, if you have anybody telling you that, oh, like just what's going on in the 70s, what happened in the 70s is the largest cohort in the population, the baby boomers, moved into their highest spending years. So you had this group suddenly arrive at the time where they're going to be spending a bunch, of buying houses, they're having kids, they're buying and working like crazy. And son of a gun, and you also had a bunch of money that we shifted around policies around savings and investing for retirement. And all of that comes together and boom, you get this boost up in demand at a time where you also had things happening internationally with energy that created a shortage in supply. This isn't the 70s. We're not going through the same thing.
So a skeptic would say,
Yeah.
Lenore, there are some similarities, right? So we had stresses on the currency in the 1970s when Nixon took us off the gold standard, the oil shock, right? Energy issues across the globe, and things that did cause the prices and things you need to go up. And as you've said on the show countless times, inflation's definition is it's the eye of the beholder, right?
Yeah, so true.
So for this audience, if you think about a financial advisor, it's not only their perception of looking at what inflation is, it's their clients who are calling in and saying, hey, I see inflation. What do we need to do in our portfolios? So given that construct, take off your macroeconomist hat. Like, how do you explain it to people who have a portfolio that they're trying to manage as they're getting into their retirement years?
How do I explain what to do, or how do I explain what this inflation is?
How to think through inflation as it relates to your portfolio.
Okay. So one of the things you can do, if you're looking at this and saying, I think this is going to go on for a bit longer, and it's quite possible that particularly there's so much uncertainty right now. We're seeing in the UK, we're seeing in parts of Asia where the virus is kicking in again. And so having these supply chains, having manufacturing continually getting hit could happen for a while. It looks like we might not be completely out of the woods on getting things back in order again. So one of the things that you could look at as a money manager is, what is, if this is going to continue on, if we're going to continue to see these higher prices coming from, say, higher commodity prices and wage hikes, because we've seen a lot of talk about that. And in fact, over the last 4 quarters, there have been over 9,000 mentions of energy prices, wages, and supply chains on earnings calls. And that's up about 50% from what we saw before the pandemic.
Great data point, by the way. Great.
Yes, it's massive. I mean, up 50% worries about wages, supply chains, and energy. That's something's changed. What you can do is look at those sectors that are really most vulnerable to high energy relative to sales. So those sectors, those businesses that need a lot of energy per unit of sales. You also want to look at ones that have a high employee to sales intensity, right? So if it needs a lot of employees for every unit of sale with wage pressures, that's something to worry about. And also if you've got an inventory to sales ratio that makes it vulnerable to supply chains. One of the things that we've seen that we're really struggling with right now is the world got so good at being highly, highly efficient, right? The just-in-time manufacturing, and the goal, and companies were really rewarded for this, if they would have a really high turnover and have very low inventory to sales, right? Something comes in and the minute it goes in, you sell it out. That's fantastic. Good job. You're managing your cash flow, except if a shock happens, right? That really high efficiency means you don't have a lot of cushions for when a shock happens and you can't get your inventory, and the world faced that this past couple of years. So when you put those together, so high energy relative to sales, high employees relative to sales, and inventory that you don't have a whole lot there. You need to get that inventory moving really quick. If you look at those are ones you probably want to, at least for the near to medium term, given that I don't think these things are going away. Probably want to be careful with those sectors. That would mean you got to be careful with material sectors, consumer discretionary, and with industrials. Those are going to be your high risk areas. Your low risk areas, obviously energy, right? Because price of energy is going up. Those margins are looking real good right now. Financials have a very high employee to sales ratio, and communication services. Those ones are going to be going to be your lower risk ones.
Awesome. You sent over some great charts on the labor market and the jobs report. Let's start at a high level. What's your take on the current situation in the U.S.?
So we've never seen anything like this. It's absolutely fascinating. So we look at what we were really disappointed. What was it? The last month of jobs report came in, and it was just a fraction of what we were expecting. And so this Friday, we're looking to get the new jobs report. We just saw from Wednesday's ADP report that private job creation was up a lot in October. That's great, but it was mostly thanks to a big jump in hiring in the hospitality sector. Good. I mean, it's nice to see the jobs, but that's a pretty low paying sector. Companies in the ADP report added a little over 570,000 jobs. That was way above the 495,000 that Dow Jones expected. And that was the best month for jobs since June, according to ADP. But if you really want to understand the health of the labor force, you really need to look at this chart here. What is absolutely fascinating to me is we're still at least 5 million jobs below where we would have been had the trend line continued, had we not had the pandemic, and had we not had kind of the Great Resignation, right? So we still lost a lot of jobs, and that goes back to our inflation thing too, where you've got like 5 million less jobs than we would have had. The economy's not going great. In September, the number of those not in the labor force and those who did not look for work in the last 4 months because of the pandemic was at 1.625 million. That's a 4-month high. So 1.625 million people said, I'm not working, pandemic, I got problems, I got childcare, whatever. Now, before the pandemic, that number was 0. That didn't exist. So the current unemployment rate, forget the unemployment rate. That tells you absolutely nothing. What you want to be looking at is how many people are actually working right now. Because if the people sitting on the sidelines that aren't counted in the unemployment rate, if they came all in, unemployment rate would go up to like 6-7%. And when you're thinking about like this economy growing and GDP going forward, keep in mind the growth of an economy is just based on 2 things: growth of the labor pool, growth in productivity. And as we can see, that labor force, really, really low compared to what it used to be. This chart amazes me. So this is the labor force participation rate. Unbelievable to me how few people are back to work these days. We had a peak in 2000, kind of came down since then, and then a massive crash from the pandemic, and it still hasn't come back up to where that trend line would have been. So when we hear about all of this wage pressure, and wages, yes, they've been on the rise, in part to the labor shortage, because look, the percentage of people that could be working who are actually working, way below what you would expect it to be. We had a 4.2% year-over-year increase in wages and the salaries component of employment. That's the highest we've seen in 31 years. And so that sounds bad, right? That's the highest in 31 years, except wage growth hasn't kept up with inflation, right? So if your wage growth isn't going as fast as inflation, buying power, which is a function of your real wages, are actually contracting. Real wages are actually in contraction because inflation's been going faster than wage growth. Now, when we look at that inflation again, there's 2 really big problems here. A decline in real incomes is not supportive of increased spending. That makes about, consumer spending is about 70% of the US economy. And that decline in purchasing power could also push people to demand higher wages. And since we've seen a lot of people still sitting on the sidelines, those people who are in the workforce have more of an ability to say, hey, pay me more or I'm out of here, right? The Great Resignation. And that push, pay me more, can lead to further margin squeeze. And that's why we're saying avoid those areas that are really high intensity of labor to sales. And we're already seeing some of these factors at work in the form of sinking real retail spending during the 3rd quarter and the rise in incidents of labor protests. So the question is, do firms give into the pressure and do wages go higher? And then they pass that cost of higher labor on in the form of higher prices? That's when everybody's arguing. But that depends on whether or not consumers actually believe that these increases in inflation are going to be sticking around. And the University of Michigan's Consumer Sentiment Report, they ask a question about the expectations 5 years out for inflation, and expectations have stabilized under about 5%. So that's not really a factor yet. That's not really where you're going to have people saying, you have to pay me more, inflation's killing me.
All right, let's pivot to the FMOC meeting. Give us your thoughts, and most importantly, how financial advisors should look at it.
Yeah, so Powell, they did about as good as they could possibly do, because they kind of backed themselves into a corner. They are going to taper. So, and that's, the tapering seems to strike fear into people's hearts. All that is they're going to reduce the amount of bonds, both the mortgage-backed securities and treasuries, that they're buying every month. They're going to reduce 15 billion each month from the current 200 or 120 billion. So 15 billion from 120, not massive amount. And that 120 billion they've been buying to force rates to stay really low. They didn't really back off on the transitory. They're pretty much sticking with that they still believe that inflation is something we're going to get through and get over it. They did acknowledge that the price increases have come faster and have been more enduring than was expected. No rate hike. The market expected that. And generally everything that they said made the market go, cool, we're pretty happy with that. Stocks trimmed their losses and moved on to make new record highs, and government bond yields inched a little bit higher, but not a whole lot because of that tapering. So overall, the FOMC and Powell really delivered exactly what the market was looking for. So good job. They telegraphed ahead of time what was going to happen, and they did what the market thought they was going to do. So there was no shocker there. But I actually think what we're seeing in the bond market, I think these yields are going to go down. So I think the market is expecting more. I think they're not going to be able to taper as much as they want. I think they're not going to be raising rates. So I think bond yields are probably not immediately, but say 6 to 12 months out, are going to be coming down.
All right, so let's wrap all this up for advisors and investors.
Okay. Right.
What should investors do given all this data that you've laid on the table?
Yeah. Okay. So what you want to do is don't believe the hype on these bond yields are going to keep going up. The bond market is telling you that inflation is not going to get out of hand. You want to stay away, although it's not going to get out of hand, but there are pricing pressures that are going to continue for some time. So you want to stay away from sectors that need a lot of employees. You want to stay away from sectors that need a lot of energy. And you want to stay away from sectors that have very, very tight supply chains and very thin inventory supplies, because they're going to continue to be vulnerable as we still work out, the problems with the ports and all that, and trying to get things back to that smooth moving machine of global trade that we used to have.
Lenore, you are always a wealth of information, data, and charts. I appreciate you coming on the show, and looking forward to having you on in the first quarter to see what unfolded here in the fourth quarter.
Thanks, Jay.